Compound interest is the eighth wonder of the world. Albert Einstein. Albert and I might disagree a little bit actually on this. What do I mean by that? Well, let's actually take a look at what compound interest is. I'm a financial advisor and consultant. I've been doing this for 13 years. I help people on their journey to get to financial independence. Okay, so if I'm an advisor and I help people with investing, why would I not believe compound interest is good? Of course, I think it's good. I think you need to have your money make some money for you. I agree with that. But what I disagree with is the fantasy of it all. You are dumb if you are not taking advantage of compound interest. Compound interest is this mystical force that we all should be taking advantage of. It's not like that. Compound interest has give and take. And people need to understand the give and take when it comes to investing, which is what compound interest is, and make sure that they are making the right choice for them and the money that they're looking at, right? Because I've seen too often where people are saving to buy their first house or some kind of money that they need in the next year or two, and they put it into the markets or some kind of like compound interest scheme that they've been told about, and it falls, or they don't have their money available when they need it. I want people to have a very realistic look at what compound interest really means and how you put it to the money that you want to grow, right? Is it a short term? Is it a long term? What is the give and take when you deal with compound interest? Okay, so let's start with what compound interest actually is. And I found a really good definition on investor.gov. And they say compound interest is the interest you earn on your interest, which is probably very confusing, but it's actually a very good definition. So then they give an example and they say, let's say you have $100 and you are getting compound interest of 5% every single year. So at the end of your first year, you're going to have $105, 5%, right? 100 plus $5, which is 5%, is 105. At the end of year two, you're going to have $110.25. Now, why not $110? You got $5 a year beforehand. Why wouldn't it be $5 again? Well, your $105 is now the base of getting 5%. So now it's $110.25. And then that $110.25 becomes the base, and then that gets 5%. So that's what they're talking about. Now, that is growing your money, is having your money grow for you by investing it in some kind of vehicle. Doesn't have to be the stock market. There are other things that can get compound interest. What I have problems with are images like this showing compound interest, or like this showing compound interest. I mean, who wouldn't want these images? Your money is growing. Look at that curve up. I mean, it looks fantastic, right? I've even seen charts where they take a penny or a dollar, and by the end of like 10 years, you have like $2 million on compound interest. In theory, yeah, that's what would happen. Is that reality? No, that's not reality, because that's reality. 2022 in the investment market, this was reality. You couldn't get any kind of compound interest because in 2022, the Fed had kept their rates down so low that still you weren't getting any kind of interest rates in any of the high yield savings accounts or CDs or anything at that point. And then the market was falling apart. So nobody was participating in compound interest that year. So let's take a look at a couple of things that you need to think about when you are participating in something that will create some compound interest for you. The first thing to think about is this compound interest going to last forever? The answer is no, it's not. You're going to have some good years and you're going to have some bad years. Now, people say, well, what about high yield savings accounts? Those are great vehicles. I talk to clients all the time about that. But there are some give and takes with that. Right now, they're getting a fantastic yield. They're getting like 4.5%, maybe a little less than that right now. That's a great rate of return or yield on your cash equivalent, right? I mean, it's liquid, you can get to it. That's a great rate of return. However, that's not going to last. Just a couple years ago, that same kind of account was getting 0.4% because the Fed had lower rates. Is the Fed going to keep their rates where they're at? No, they've already said that they're going to start to lower them sometime in 2023. Where is that account going to end up? I don't know, 2.5%, maybe lower, maybe higher. I have no idea. My crystal ball does not work. Okay, so you cannot guarantee that you're going to continue to get that same rate of return. Now, is it better to get 0.4% than 0.002% you were getting at the bank? Yeah, but you have to be mindful of how all this works. And you have to really choose the institution you're working with very carefully. FDIC insurance, make sure you check them out, due diligence, all of that. Now, people say, well, what about CDs? I can get, a 30-year CD and they're getting 5% now, maybe 5.35 I've seen as the highest. Wow, that's great. That would be compound interest. 30 years, 5.35% every year. Sign me up. Wait a second. You mean I don't have liquidity on that money? You mean I can't take that money out when I need it? That is a trade-off. That is one of the things with CDs, is that if you take your money out, you're going to lose some interest on it. And you're going to lose that power. If you take some money out, you can't just put it back in and say, okay, now I'm ready for my 5.35% again. It doesn't work that way. Then you have to get a new CD. So there's give and take with this, right? Longevity, liquidity risk. The last thing is the market. People say, oh, if you just index it, S&P 500 on average is getting 8% or whatever number they put out there. And that's what you should do. That's compound interest. Yeah, it is. I mean, it does very well. The markets, I wouldn't be telling people to go in the markets if over time it hasn't helped people. But you have bad years. You have years like 2022. You have years like 2008. There are bad years still coming up, and you are not going to get your 5% rate of return that year. You're going to get negative 30% if you're in maybe the S&P 500, right? You have to have those trade-offs. And so how are you going to react when you're, bopping along at 7-8% and all of a sudden you're down 30-35% in the markets? Are you going to panic? Are you going to sell? Are you prepared for that? That's the problem I have when we show images of compound interest going from $1 to $2 million. That's not life. You are going to have ups and downs in the market, just like everything in life. And you have to be prepared for that. So, in conclusion, compound interest is a great thing to start taking a look at, adding into your financial education, adding into something you should be exploring for yourself, because you do want your money to grow. If it's not growing with inflation, which historically is about 2.5%, then it's actually going backwards in value, because if it's not keeping up with inflation, it's losing buying power. I could do a whole other video on that. But when you take a look at compound interest, I want you to look at it with open eyes, complete understanding, and don't feel guilted into investing until you're ready because somebody told you you're stupid because it's the eighth wonder of the world. Okay? So we help people on all different types of their journeys, whether they're just starting, whether they've had investments for a while, whether they've just been a participant in their 401k and have no idea how it's been invested. We help people all the time. So feel free to get us on a get to know you call. There is a link down below in the description, and we can just kind of get to know you and see if we can help you in any way. One Vision Retirement, your retirement in 2020 vision.